Luxembourg considers German-style rent register system to monitor housing market. A recent report suggests that Luxembourg could benefit from creating a rent register, inspired by Germany's Mietspiegel rent mirror system, which helps regulate and monitor rental prices. The Housing Observatory, part of Luxembourg's housing ministry, highlighted this proposal in an analysis published on February 4th. The German system, which considers factors like property size, location, age, and energy efficiency, serves as both a tool for observing the rental market and a reference for landlords and tenants to set or adjust rents. Additionally, Germany's Mietpreisbremse rent brake mechanism limits rent increases in high-demand areas, ensuring new rents do not exceed the reference rent by more than 10%. The report, authored by researcher Antoine Pacoud and senior government advisor Mike Mathias, explores how Luxembourg could adapt this model. The primary goal of a rent register would be to provide a reliable reference for rent disputes and new lease agreements. Unlike Germany, where local authorities manage the Mietspiegel, Luxembourg's smaller size and interconnected property market suggests that a national approach would be more effective. This would require establishing a legal framework to support the creation of a rent register. The report emphasizes that a rent register would enhance Statec's ability to analyze rent levels and trends, currently based on limited surveys. It would also serve as an independent observation tool, offering insights into rental prices without directly linking to rent control policies. The authors propose that implementing such a system could be streamlined by conducting ongoing rent surveys or reintroducing mandatory lease registration, at least for certain types of housing, like shared accommodations, which make up over 15% of rental listings. In summary, the report outlines a multi-step approach to creating a rent register in Luxembourg, covering various housing types and ensuring national oversight. This system would provide valuable data for policymakers and stakeholders, while potentially curbing excessive rent increases. The decline in real estate sale prices has significantly lowered the prospects of capital gains in 2023. As a result, in 2024, the estimated net rental yield has even become slightly negative, according to a report published by the Housing Observatory on Tuesday, February 4th. In simple terms, renting is no longer profitable. After a sharp acceleration from 2018 to 2022, with real estate price growth peaking above 15% over 12 months at the end of 2020, the sudden rise in interest rates in mid-2022 reversed this trend in the real estate market. In the existing property market, prices have undergone a significant adjustment. They fell by approximately 15.7% between the third quarter of 2022 and the fourth quarter of 2023 for apartments, partially offsetting the loss of purchasing power caused by rising interest rates, the Housing Observatory analyzes in its report. The observatory specifically examined estimates of rental investment returns. The approach focuses on the instant gross rental yield, which is the ratio between the total gross annual income generated from renting the property, excluding rental charges, and the purchase price of the property. Difference between gross and net yield. Here's a rewritten version of your text in my style. Rental yields in Luxembourg. Trends, speculation, and future outlook. Julien Licheron, an economist at Lizer and author of a recent report, analyzed gross rental yields by merging two key databases from the Housing Observatory. The first dataset came from notarized deeds provided by the Administration of Registration, Domains, and V8, while the second consisted of real estate rental listings from imotop.lu, a property portal partnered with the Housing Observatory. According to the report, from 2010 to 2018, the average gross rental yield remained relatively stable, fluctuating between 4.26% and 4.56%. However, between 2018 and mid-2022, a sharp decline occurred due to a surge in property prices, rising as much as 16.3% in 2021 while rental prices failed to keep pace. By 2022, the average gross rental yield had dropped to 3.04%. In 2023, the trend reversed, with the instant gross rental yield rebounding to 3.74%. Looking ahead, projections suggest that in 2024, it will return to levels closer to those seen between 2010 and 2018, according to the Housing Observatory. Market correction and the speculative factor. Since mid-2022, Luxembourg's property market has experienced a significant correction, with prices for existing apartments declining by 15.3%. Meanwhile, advertised rental prices have continued their previous trajectory. As a result, rental yields have improved. Despite this, the Housing Observatory highlights a key distinction between gross and net rental yields. Licheron explains that net rental yield accounts for financing costs, capital gain prospects, and investment-related taxes. He emphasizes that capital gain expectations, especially between 2017 and 2022, played a major role in shaping net rental yields. From 2010 to 2019, expectations for capital gains remained relatively stable. However, as property prices soared from 2018 to 2022, investors increasingly anticipated further price growth, driving up demand. This introduced a speculative element to the market, as investors banked on future appreciation rather than rental income. With interest rates rising in mid-2022 and property prices dropping in 2023, these expectations shifted dramatically. By late 2022 or early 2023, capital gain prospects had turned negative. In 2024, this decline has even pushed net rental yields into negative territory, according to theoretical estimates. Licheron suggests that this shift, combined with higher interest rates making alternatives like bonds more attractive, has dampened investor enthusiasm for rental properties. New report on Luxembourg's rental registry. On February 4th, the Housing Observatory also released a separate report exploring the feasibility of a rental registry in Luxembourg. The study examines Germany's neighborhood-level rental data system and its potential applications in Luxembourg to better regulate rents. More details on this analysis will be available in an article set for release soon. Between 2018 and 2022, the real estate market experienced rapid growth, with property prices surging, peaking at over 15% annual growth by the end of 2020. However, a sharp rise in interest rates in mid-2022 caused a market downturn. According to the Housing Observatory, property prices in the existing home market have undergone a notable correction, dropping approximately 15.7% from the third quarter of 2022 to the fourth quarter of 2023 for apartments. This decline has somewhat offset the impact of rising interest rates on buyers' purchasing power. The Housing Observatory also analyzed rental investment returns, particularly the instant gross rental yield, calculated as the ratio between a property's annual gross rental income, excluding rental charges, and its purchase price. Gross versus net rental yield. Julien Licheron, an economist at Lizer, examined gross rental yields using two key data sources: notarized property sale records from the Administration of Registration, Domains, and VAT, and real estate rental listings from imotop.lu, in collaboration with the Housing Observatory. The findings reveal that from 2010 to 2018, the average gross rental yield remained relatively stable, fluctuating between 4.26% and 4.56%. However, between 2018 and mid-2022, the yield declined sharply due to skyrocketing property prices, which rose by as much as 16.3% in 2021. Rental prices, in contrast, did not follow the same upward trend, leading to a gradual decline in average gross rental yields, which fell to 3.04% by 2022. In 2023, the gross rental yield rebounded to 3.74%. The Housing Observatory expects it to return to levels closer to the 2010-2018 average in 2024. Since mid-2022, apartment prices have seen a significant correction, falling by a cumulative 15.3%, while advertised rental prices continue to follow previous trends. This led to the increase in gross rental yield to 3.74% in 2023. By 2024, the yield is projected to align more closely with historical averages. However, the report also emphasizes the gap between gross and net rental yields. As Licheron explains, net rental yield accounts for additional factors such as financing costs, capital gain prospects, and tax considerations, excluding property sales. From 2017 to 2022, capital gain expectations played a major role in shaping net rental yields. The speculative element. Between 2010 and 2019, capital gain expectations were relatively stable. But as residential property prices surged, so did investor expectations of future price growth. This, in turn, likely fueled demand from rental investors, contributing further to rising prices, a speculative component in the market. Between 2018 and 2022, these rising expectations were a key driver of price increases. However, with interest rates climbing in mid-2022 and property values declining in 2023, capital gain expectations dropped significantly. By late 2022, short-term projections had already turned negative, and by 2023, longer-term expectations followed suit. A graph included in the Housing Observatory's report highlights the disparity between gross and net rental yields. The economist notes that the sharp decline in property prices in 2023 severely reduced potential capital gains. As a result, by 2024, the estimated net rental yield even turned slightly negative. While this is a theoretical projection that doesn't account for a property's full holding period, it helps explain why investor interest in rental properties has waned in 2024. Higher interest rates have made alternative investments, such as bonds, more attractive in comparison, further dampening enthusiasm for rental real estate investments, the report concludes. The decline in real estate sale prices has significantly lowered the prospects of capital gains in 2023. As a result, in 2024, the estimated net rental yield has even become slightly negative, according to a report published by the Housing Observatory on Tuesday, February 4, 2025. In simple terms, renting is no longer profitable. After a sharp acceleration from 2018 to 2022, with real estate price growth peaking above 15% over 12 months at the end of 2020, the sudden rise in interest rates in mid-2022 reversed this trend in the real estate market. In the existing property market, prices have undergone a significant adjustment. They fell by approximately 15.7% between the third quarter of 2022 and the fourth quarter of 2023 for apartments, partially offsetting the loss of purchasing power caused by rising interest rates, the Housing Observatory analyzes in its report. The observatory specifically examined estimates of rental investment returns. The approach focuses on the instant gross rental yield, which is the ratio between the total gross annual income generated from renting the property, excluding rental charges, and the purchase price of the property. Difference between gross and net yield. When you analyze gross rental yields by combining two databases from the Housing Observatory. First, data from notarized deeds provided by the Administration of Registration, Domains, and VAT. And second, real estate rental listings from the property portal imotop.lu, as part of a partnership with the Housing Observatory. The report shows that the average gross rental yield was relatively stable between 2010 and 2018, ranging between 4.26% and 4.56%. Between 2018 and mid-2022, however, there was a sharp decline in the gross rental yield due to a significant increase in prices, up to plus 16.3% in 2021, contrary to the previous trends in advertised rents. The average gross rental yield gradually deteriorated, reaching 3.04% in 2022, according to our estimates. The report states, the instant gross rental yield rebounded to 3.74% in 2023 alone. In 2024, it is expected to return to levels closer to the average gross rental yields recorded between 2010 and 2018, the Housing Observatory explains. Since mid-2022, we have observed a sharp correction in sale prices, a cumulative minus 15.3% for existing apartments, while previous trends continue in advertised rental prices. As a result, the instant gross rental yield has risen to 3.74% in 2023. It should return in 2024 to a level closer to the average gross rental yields recorded from 2010 to 2018. However, the Housing Observatory highlights a significant difference between gross and net rental yields. According to Julien Lecheron, the net rental yield should include the gross rental yield, financing costs, capital gain prospects, and investment-related taxation, excluding property sales. It is clear that the estimated net rental yield has been heavily influenced by capital gain expectations, particularly their surge between 2017 and 2022. The speculative component. Capital gain expectations were likely quite stable between 2010 and 2019. Then the sharp increase in residential property price growth rates gradually fueled higher capital gain expectations, which in turn may have driven demand from rental investors. This introduces a speculative component. The prospect of rising future property prices may have attracted rental investors, further driving up prices. This increase in capital gain expectations was likely a key factor in the rise in real estate prices between 2018 and 2022. The rise in interest rates in mid-2022 and the subsequent drop in housing prices in 2023 have drastically impacted capital gain expectations. These expectations turned negative by the end of 2022, assuming short-term adaptive expectations, or in 2023, assuming longer-term expectations. The decline in sale prices significantly reduced capital gain prospects in 2023, so much so that in 2024, the estimated net rental yield even became slightly negative. Of course, this is a theoretical estimate that does not take into account the total holding period of the property, but is simply a projection of the investment's profitability for the coming year. However, this theoretical estimate explains investors' lack of interest in rental property investments in 2024. This is especially true as the rise in interest rates has made some alternative investments, such as bonds, relatively more attractive, concludes The Economist. On Tuesday, February 4, 2025, the Housing Observatory also published another analytical report focusing on the challenges and steps required to establish a rental registry in Luxembourg. The report examines Germany's system for collecting precise rental data at the neighborhood level and explores potential applications of such a system to better regulate rents in Luxembourg. The Luxembourg housing market, trends, challenges, and future outlook. Introduction. Luxembourg, one of the smallest yet wealthiest nations in Europe, has a housing market that continues to be a focal point for residents, investors, and policymakers alike. Despite its small size, the country's strategic location, strong economy, and high demand for real estate have contributed to skyrocketing property prices, making housing affordability a pressing concern. In this blog post, we'll explore the key factors driving the Luxembourg housing market, analyze the challenges it faces, and look ahead to potential solutions and trends shaping the future. 1. Overview of the Luxembourg housing market. Luxembourg's real estate market is characterized by high property values, strong demand, and limited supply. The country's growing population, fueled by an influx of expatriates and cross-border workers, has intensified the housing crunch, making it one of the most expensive places to live in Europe. Key statistics. Average property prices. In 2024, the average price per square meter in Luxembourg City exceeds €12,000, with some premium areas reaching €15,000 per square meter. Rental prices. The cost of renting a one-bedroom apartment in the city center is around €2,000 per month, with suburban areas offering slightly lower rates. Home ownership rates. Approximately 70% of Luxembourg's residents are homeowners, but affordability challenges have slowed the growth of new buyers. 2. Factors driving the market: economic strength and high incomes. Luxembourg boasts one of the highest GDP per capita in the world. With a robust financial sector, low unemployment rates, and attractive salaries, the purchasing power of residents remains strong, fueling demand for real estate. B. Population growth and immigration. With over 50% of its population composed of foreign nationals, Luxembourg has seen continuous population growth. The influx of expatriates and cross-border workers has significantly increased the demand for housing, especially in urban areas. C. Limited land availability. Due to its small size, Luxembourg has a limited supply of land available for new developments. Strict zoning laws and environmental regulations further restrict construction, exacerbating the housing shortage. D. Favorable tax policies for investors. Luxembourg remains an attractive destination for real estate investors due to its favorable tax policies, such as capital gains, tax exemptions on primary residences, and tax benefits for landlords. This has led to high levels of property speculation, driving up prices further. 3. Challenges facing the market. A. Housing affordability crisis. While Luxembourg's high salaries help many afford housing, the rate of price increases has outpaced income growth. First-time buyers struggle to enter the market, leading to increased demand in the rental sector. B. Shortage of affordable housing. Despite government initiatives, the supply of affordable housing remains insufficient. The private sector's focus on high-end developments has left middle and lower-income residents with fewer options. C. Impact of rising interest rates. With the European Central Bank, ECB, increasing interest rates to combat inflation, mortgage rates in Luxembourg have risen. This has made borrowing more expensive, discouraging potential homebuyers and slowing down property transactions. 4. Government measures and policy responses. A. Subsidies and grants. The Luxembourg government has introduced various subsidies and grants to support homebuyers, including financial assistance for first-time buyers and low-interest loans for housing development projects. B. Increase in public housing projects. Efforts are being made to expand social housing and affordable rental options. The government has launched initiatives to build more public housing units in an attempt to stabilize the market. C. New zoning and urban development plans. To address land scarcity, new zoning regulations aim to optimize land use, promoting high-density housing in key areas while preserving green spaces. 5. Future outlook and predictions. A. Potential market correction. With rising interest rates and slowing demand, Luxembourg may experience a market correction where property prices stabilize or decline slightly in the coming years. B. Increased focus on sustainable housing. The push for energy-efficient homes and sustainable urban planning is expected to grow, with incentives for green buildings becoming a more prominent aspect of Luxembourg's housing policies. C. Continued government intervention. Further policy changes, such as rent control measures and higher property taxes on unoccupied homes, may be introduced to curb speculation and promote affordability. Conclusion. The Luxembourg housing market remains one of the most dynamic yet challenging in Europe. While economic strength and high demand continue to drive prices, concerns about affordability and limited supply persist. Government policies and market adjustments will play a crucial role in shaping the future of housing in Luxembourg. Whether you are a prospective buyer, investor, or renter, staying informed about market trends and policy changes is essential to navigating this evolving landscape.